Hi guys, welcome to the Savvy Money Show with me, your host Sean. You guys have been amazing. The comments, the questions, all the support I've received from you. This channel would be nothing without you guys, so please keep it up. Now, I want to do an in-depth analysis of some stocks I'm looking into, but before I start that, I'm going to discuss some stocks I picked up today and my reasoning behind it. Now, I received some dividends today from Microsoft, from ExxonMobil, even though I sold it, and a few other companies, so put that to good use, along with some other money I had on the sidelines. Now we start with Walgreens Boots Alliance. I said how like 30 to 35 is a good price. You can see how it's come all the way down and it's kind of hitting the sideways pattern. Now the dividend of 5.39% it's a good dividend. The P ratio, Yahoo Finance is wrong. It's got a low PE ratio as well. Now, you can see how it's only $12 above its book value. Now, I really do think people are missing a trick with this. This is my kind of hedge against the second wave. It's my hedge against you. Those of you who have been with me for a while will remember that I picked up some CVS Health against the hedge against the second wave. And I'm thinking to myself, I'm picking up CVS Health, but then what about Walgreens Boots Alliance? Now, it's a recovery play. It's if there's a second wave, it will come into effect. If a vaccine comes out, how are they going to give it to everyone? Are they going to have the hospitals with lines outside the door? No, they're going to have these pharmacies give it. And I did an in-depth review into it before. You might want to check that out, but 65 billion in liabilities, 86 billion in assets. It's got no problem paying them off. Sorry about that. And it has 4 billion in free cash flow. Now, they are instigating an e-doctor service in their sites. They're trying to set that up, which I think will be massive for them. Those of you who have had a Boots card will know they've totally revamped the Boots Advantage card system. They will be taking a lot more data and accumulating that and using that to target things towards you, and that is a massive thing for them. People are not even looking at that sector. They have an online sales sector and people are thinking they're just the in-store. I have used the online sector before. It is good, it is efficient. It's not like Amazon Prime efficient, or Walmart Plus. Not that I've used Walmart Plus, but it is good. And they do special events like the baby events and other events if you buy online. Now, they have a massive amount of stores. If your kid is crying up at night at 7 o'clock at night when most pharmacies are closed, you're going to go to a Boots pharmacy. There's no doubt about it. I just think with a 7p, it's well worth it. Another one. Look at that. Now, it was at over $17.50 a share. Now, it's for forbearance, which has hit it. That's about to end. So I've gone into it. You know who else has gone into it? The CEO has scooped up $3 million worth of shares last couple of days. Now, dividend of 2.9%. They're still paying it. I received the dividend in July. I received the dividend the last quarter. Now, the thing is, the CEO's got faith in the company. He hasn't been buying it all this time. He's buying it now. So it's an undervalued company. They don't put these guys. They don't put proper PEs on. Now it's a P of let's not muck about. Now trading 212 isn't the best when it comes to PE. You know. Let's see now. Yeah, I know I've got way too many stocks, but this is my spec. This is my spec play. Now, my spec portfolio. So there you go, 1.51. And I know if it's a PE of under 5, you've got to be worried. You've got to go into the company. But this is residential mortgage-backed securities that are guaranteed by the United States government agency. So they're backed by the government. You know, they're not gonna, it's not like going to a small bank and their mortgages, which they have to write off. These are backed by the governments. So I don't see why more people are not going into it. Amazon. Said before, look, I said before, when it's under 3,100, it's worth picking up. $3,090 a share. I scooped some up. So now I've got just over 3 Amazon shares. If it hits, if they announce a stock split, which they should do in my opinion, I think Mercado Libre, Meli, I'm not going into them because I've missed the boat on that. I think that's over $1,000 a share. At $500, I recommended them, and I'm kicking myself for not going into it myself. But I had other opportunities I needed the money for. I think Mercado Libre and Amazon and Chipotle should be doing a stock split. Also Shopify. But if they don't, they don't. But it's still an amazing growth company. Amazon can spend my money better than I can spend it. They can invest it better than I can spend it. For those who say, oh, but it doesn't pay a dividend. Now, if they announce a stock split, it will go to 4,000 easy. Google, I bought at 1,500 on the dot, and I get that it was under 15. I think for one point, 14.95, but for the sake of a fiver, now, in my opinion, the intrinsic value is 1,400. when you look at the price of these tech stocks and you look at Google's balance sheet and everything they've done, it's a good price. I think Google, the FAANG stocks, Facebook and Google, are the two best valued ones. After that it's Apple, but anyway, space, the final frontier. Why? They're in the final milestones of testing. I've done an in-depth video about this as well, so have a lot of other people. You might want to check some of that out. They're not far from getting FAA approval. And it's not just the space thing that gets me, it's the interstellar travel. Basically going London to New York in under an hour. You know, Concorde Mark II. That's what I'm looking forward to, because all these 750 people who have paid a massive amount of money, how many of them will be physically fit to go to space? And apparently there's been in-buying in, well, realty income. Sold at 65 because I needed to move the cash somewhere, and it came down to 62.5, and I snapped it back up again. You know, I lost the, I didn't even lose a month's rental income from it because of the way I timed it. So why wouldn't you want to own it? And I ended up picking up more as a result. Now, after this next plug and message, sorry for the shameless plug, but we'll move on to the in-depth reviews. And don't forget to hit that lovely like button, almost as lovely as me. Helps with the YouTube algorithm and getting the video out to more people. And don't forget to hit that subscribe button if you haven't already. Become part of the Saving Money Show family. We give each other hints and tips and updates about stocks and shares we talk about on the show. As well as that, you can ask me to look into any share you want, and I don't charge a Discord fee or ask for a Patreon. All I do ask is for you to comment in the box below and hit the like button. Even if you disagree with me, especially if you disagree with me, I like a debate. And if I do something wrong, I want you to call me on it so I can improve the channel. And why not check out the links in the description below? There's lots of others. I've used each one of them myself. I wouldn't give you links if I haven't checked them out myself. If you're looking for a free trading platform which should trade your stocks and shares, you know, you can get a free share worth up to £200 for signing up and depositing a small amount. A free trade only requires a £1 deposit. The others require £100 or dollars, depending on which one you go for. Stake has over 3,500 US stocks on their books, which is the biggest one outside of the US. Whereas Trading 212 is one of the best and easiest platforms to use. But as I said, I use all three. Anyway, on with the show. Now, welcome back. You may notice I've spoken about some of these before. Now, TriPoint, it has a P ratio of 8.86. The earnings date's coming up in a month or two. The intrinsic value is 20.26. The analyst's value is 19.79, so you're getting it below the intrinsic value and analyst value. The year-to-date gain is 15%. the total assets to total liability ratio is 2.21. Revenue growth is 5%. Levered free cash flow is 17.1%. Operating margin is 11.8%. Net income is at 8.3%. Now, this is one of my favourite ones. The ones I'm discussing today. I think you can understand why. Although I'm not a fan of analysts, I do use analysts' price targets to confirm my own research. That's why I'm putting them in. And we go on to SGU. Now, it has an intrinsic value of 10, an analyst target of 13. There's an 88% buy rating on that. Revenue growth is minus 13% and operating margin 5.4%. It's with growth stocks, it's not unusual to have a minus revenue growth margin, so that wouldn't put me off. Has a free cash flow of 11.8%. So if you look at the PE ratio, it's 10.06 and it pays a 5.62% dividend. Yeah, but you have to check whether or not you think that is sustainable. Now, you have missed the dividend this time around though, but earnings are in December. 10-cent music entertainment. If you remember, I owned some of it until Trading 212 made me sell it from my ISA. Now, it's got an intrinsic value of 17.59, an analyst value of 18.28, free cash flow of 21.3%, total assets versus total liability of 6.45, which is amazing. I know some of you are wary of trying these stocks in case there's a problem, but when it has 6.45, you want it over 1, but 6.45, revenue growth of 22.9%, operating margin of 14.6%. Now, I couldn't believe it when people said to me, but the PE ratio is 48.47%. And these are people who are in on Tesla. I'm in on Tesla. You know that. But, you've got revenue growth. You have a 15% up margin. You have it below the analysts and the intrinsic value. It has 1/5, more than 1/5 free cash flow. 21% free cash flow. It's amazing. And then 6.45. That means if no money comes in, it can go for just under 6.5 years. No money coming in. It doesn't mean that technically. It just means that it can pay off its liabilities 6.5 times. Sorry about that. I don't want to mislead you. I'm using the wrong ratio. Sorry. The thing is, this is a company that I think is very good. And full disclosure, I went into this by accident. I was looking for 10 cent and I was in a rush, and this is one of the dangers of mobile app brokerage. I'm walking along the street putting in 10 cent and I've seen the price and I thought, cool, that's amazing, and I've clicked buy, and then I've seen 10 cent music and oh no. But then when I've looked into it, I've seen all this, and I'm glad I did buy it. Of course, then Trading 212 have made us get rid of it. Right, enough of that. On with the show. RCM Inc. Intrinsic value is 1607, so it's not just below the intrinsic value. Analyst value of 17.57. Free cash flow of 4.4%. A total assets versus total liabilities of 1.33. Revenue growth of 15.3%. Operating margin of 10.6%. So we want our operating margin to be above 10%, and it's only just hitting that. And we can see the PE ratio is high, it's 112.89, but you know, it's, oh sorry, it's only just started getting. Now CYD, you will see a trend that I've tried to go for companies that are either under the intrinsic value and analyst value or just around there, and at some point recently have been under. CYD, intrinsic value of 17.38, analyst value of 21.03, doesn't have any free cash flow unfortunately, and the revenue growth is 13.2%, and the operating margin is 4.8%. and you look at total assets versus liabilities, you can see that the ratio isn't, we don't have a ratio because it's more liabilities than there is assets. Sorry about that, that was wrong. It's a 45, sorry, I'm trying to blink. Yeah. So it's a ratio of 2, sorry, 1.9, sorry. I just went blank there for a minute. Don't know what's wrong with me. Anyway, HBI is intrinsic value of 18.75. Remember, I am doing all this from memory. I have 1 or 2 figures written down from when I did my research, but most of this I'm doing from memory. HBI is 18.75 intrinsic value. The analyst is 16.2. The total assets versus total liabilities is 1.15. Revenue growth is -4.2. The operating margin is 14.4. Free cash flow is 11.3. And you'll see it gives a 3.93% dividend, 10.61 PE ratio. EGO has an intrinsic, or Dorado Gold, I put that in my gold stocks to buy, has a intrinsic value 14.2, analyst value of 12.5, free cash flow of 10.9, revenue growth 3.77, sorry, what's that? Total assets versus total liabilities of 3.77, revenue growth of 92.8%, but then, you know, price of gold has gone up. Operating margin of 20.4%. Now, you can see there, PE ratio of 13.19. You know, I wanted to include Dorado Gold, not just because it's below the values, but because its values had changed since I last done a review on it, because the price of gold has fluctuated. BSIG, Bright Sphere Investment Group. Now, the intrinsic value of 15.17, analyst value of 16.5, a P ratio of 5.71, dividend of 0.31%, and levered free cash flow of 20.5, total assets versus total liabilities of 1.2, revenue growth of -11.2, operating margin of 40. Now, all of that is amazing. We'd like the total assets versus total liabilities to be a bit higher, but it's above 1, which is fine. Operating margin 40. The revenue growth is a minus, fair enough, but it's, you know, that sort of thing. You could expect that with what's happened with the stocks this past few years, and it's not exactly a flourishing company. You know, it's not an experienced company, but anyway. Oh, sorry. And we have CECE, which is CISO Environmental Corp. Now, this has an intrinsic value of 9.55, an analyst value of 9.25, free cash flow of 5.2%, P ratio of 16.83. Its last dividend was in 2017, so I wouldn't expect a dividend. Now, its total assets versus total liabilities is 1.91. Revenue growth is minus 5.4. Operating margin is 6.9. By the way, I forgot to say, Dorado Gold was also one of my favourites, as is Fortura. However, with Fortura, we're running out of time, so I have to be a bit quicker. The intrinsic value is 18.55, P ratio 33.85, analyst rating is 16, year-to-date stock gain is 26. I'm sorry, but we're kind of out of time. Don't forget to comment in the box below whether you hold any of these, or you're looking into getting any of these, or what you've been buying today. Don't forget to hit the like button. It really does help with the YouTube algorithm and getting the video out to more people. And I'll see you in the next video. Remember, stay safe, stay savvy, stay investing. That's all for now. Goodbye.